Hi, I'm Mike Kirsopp. I'm Chief Operating Officer at Cambridge and Counties Bank, and also I chair the Credit Committee. I think the first advantage that people would say is I own this, I have control of it, and if it goes up in value, I keep the appreciation of that capital value. It also means that you know exactly how much that you want to spend in terms of renewals, refurbishment, and it also gives you that opportunity to develop the property as your business grows or as opportunities come to maximise returns. The disadvantages of ownership can always be that property values go down as well as up, interest rates can go up as well as down, and on the rental side you have some instability in that you usually will only be able to rent for relatively short and medium term periods to actually fix your known costs. For both of those, the first stage is to clearly understand your aspirations and your intentions and motivations. So you will need to be able to convince your lender as to why this is the right building and why you're the right person to borrow to purchase it. Looking at the investment, however, the first things that you'll need to put together are what's the rental income, what is it now, and if there is a potential to develop that income, what will it be in the future? You'll also need to be able to have 3 years accounts or VAT returns if you don't have accounts, and you'll also need to be able to put together an assets, liabilities, income and expenditure statement. That's merely really a list of the assets you own, the liabilities and the borrowing you have against them, and your income and expenditure. All lenders will be looking for investors in commercial property to let each building stand on its own feet. So they'll be looking to see that that rental income from that building will service and repay the debt. If we turn to owner-occupier, i.e. you're buying the building for your own business's use, what's most important is to have a business plan that shows that the business will be able to service and repay that debt, not just now, but given the plans that you've got for the development of the business and its trading performance into the future. So it'll still be 3 years accounts and or VAT returns if you don't have them. But there will be necessarily that unknown about how the business is going to develop, and the bank will be always interested in investigating that with you. In lots of respects, they are actually the same type of product, but with commercial mortgages, the first thing you have to know is that the amount that a bank is prepared to borrow is usually less than they would do on a residential mortgage. Capital values change, and the most that banks will do is around 70% loan to value. You may be able to get a period of interest only before you start making capital repayments, and again that's open to negotiation and will reflect the way in which a building produces income. When buying commercial property, what you need to consider is in what name you want to buy it. Is it your personal name, partnership, limited liability partnership, company, PLC, trust, or for commercial property even your SIP, SAS or other pension fund. All these options are available when buying commercial property. In most cases, banks will quote a term of up to 20 years to purchase commercial property, but there is one point that you really need to watch out for. Very often, whilst giving a 20-year commitment, there is a review term, either at 5 or 10 years, when they want to look at how that asset is performing. Is it still producing the income that was expected? Does it still have the same capital value? Business rates will apply to every property that you buy. On a commercial property, they're the equivalent of council tax that you might pay on your own home. Councils will assess a rateable value for each property, and then they will charge a rate in the pound against that value. You also need to understand that if you are an investor buying a property, if the property is empty and you don't have a tenant, you will be responsible for making those rates payments. There are as many implications to consider as there are A, commercial properties and B, commercial property borrowers. But what I would say is at the transaction, at the time that you purchase it, you do need to take into consideration things such as stamp duty and whether the building carries a VAT liability. You need your accountant involved, and I would suggest it's best to involve them before you commence the transaction. On the longer term, then clearly there's the normal commercial tax to take into consideration based on the income that the building produces. First and foremost, you need to involve your accountant, and I suggest you involve your accountant before you start the transaction. Secondly, you need a good commercial property lawyer. Commercial property transactions are very rarely as simple and straightforward as they are in the residential world. For this reason, I also recommend that business people have their own surveyor and valuer involved as well. Not just because they'll be giving them a view on the value of the property and the offer price that they may wish to give for it, but they'll also be able to give you an insight into things such as alternative use, development potential, and anything to do with what is quite a complex planning law. Cambridge and Counties is a bank that's focused on business people, and it's focused on property finance, especially commercial property. So we have deep experience across all parts of the bank, and I think that's what enables us to give a good personal service to people with also a commercial understanding. That commercial understanding is that, of course, property transactions in the commercial market are rarely straightforward and without problems along the way. So it is always our intent to be there when we need to be there for our customers, to be fleet of foot, to be contactable, and above all else to be commercial.